Okay, good afternoon, everybody. This is Jill Hanken at the Virginia Poverty Law Center. This is our third webinar discussing various aspects of the Affordable Care Act. I'll remind you at the end of this webinar where you can find recordings of the previous two webinars and other information. So today we're going to be talking about the Medicaid eligibility changes that are taking place as a result of the Affordable Care Act, and we'll also talk about the Medicaid expansion in Virginia and where things stand. So to get started in our discussion today, I thought it was important to sort of begin with a quick overview of where we are today with Virginia's Medicaid program. You know, what are some of the categories of coverage in current Medicaid, and how might some of that change, and how might some of the eligibility levels change? So let's start where we are today. And right now in Virginia, children under age 19 can get Medicaid where their family income is under 133% of the poverty line. There's also a spend-down program for children whose income is higher, but these days most children with higher income can go into our famous program because that program does cover kids up to 200% of the poverty line. But for children who have income even above 200% of the poverty line, there is a spend-down aspect of the program which allows people to get Medicaid if they incur very high medical expenses. With the 133% of the poverty line group for kids, there are certain income disregards that apply. When evaluating eligibility. For famous, it's a gross income test. Another category in our Medicaid program for kids is for certain foster care kids and children getting adoption assistance. The income level for that group, and that goes for children under age 21, that eligibility group, the income levels vary by locality in Virginia, and like parents and caretaker relatives, very, very low income levels. So again, most of those children typically will get their coverage through regular Medicaid or famous, and then when they hit 19, then they might have to qualify under even more restrictive income rules to stay on the Medicaid program. Our coverage for parents and caretaker relatives is among the lowest in the whole country. I think we're ranked like 44th in the nation. We have 3 groupings of localities with very low income levels, which are under 30% of the poverty line statewide, and that means that in order for parents to get Medicaid coverage, their income has to be below about $10,000 a year for a family of 4, so really low. Another important Medicaid category is for pregnant women, and it's basically like the category for kids, 133% of the poverty line with a spend-down opportunity, and we now have the Famous Moms program that goes up to 200% of poverty. We have in our program a small program called Plan First, which provides family planning services only to men and women if they have income up to 200% of the poverty line. Then there's also a small program that's run through the Medicaid program for people who have breast and cervical cancer, and if they have income up to 200% of the poverty line, and people to get into this treatment program have to be certified by a CDC health clinic before they can get their treatment actually paid for through the Medicaid program. We also have Medicaid categories for the elderly, that is people over age 65, people who are blind, and people who are disabled. The shorthand for that is ABD. And within that broad umbrella, there are a number of different categories. The main one is for the ABD with income under 80% of the federal poverty line. And this group also has a spend-down opportunity for people whose income is above 80% of the poverty line. There are long-term care services provided through Medicare in both Medicaid, through both nursing homes and through a variety of community-based care waiver programs. Income eligibility for that is set at 300% of the SSI income level, which takes you up to about $2,000 a month, $2,100 a month. And there is a spend down for most of these long-term care categories. Not all the waivers have a spend down program, but most of them do. Medicaid also provides limited benefits to low-income Medicare beneficiaries. This is called our Medicare Savings Program for people in that income range from 100 to 135% of the poverty line. And what this gives people is assistance with paying for some of their out-of-pocket Medicare expenses. Now, for these ABD groups, there are also resource rules, meaning there are limits on how much money people could have in assets and bank accounts and cars, etc. The resource rules don't apply to the categories I described previously. So that's a real quick overview of the basic Medicaid categories. Other adults, like people who are not parents, they're not pregnant, they're not age blind or disabled, are not covered at all in Virginia's current Medicaid program, even if they are destitute with absolutely no income at all. So people have to fall into one of these categories that I described and meet the financial rules in order to get Medicaid. And just as a reference, this is the link to the Medicaid policy manual that's online that you can see the detailed policies for all of these various categories. Let's talk about what the ACA does to the Medicaid program. Well, first of all, it consolidates some of the categories, and we'll talk about that in a minute. And it changes the way income is counted to a modified adjusted gross income test. And if you were on the previous webinars, you know that MAGI, the modified adjusted gross income, is also the system for looking at a household's income for purposes of the health benefit exchange or the health insurance marketplace. The new health insurance marketplace also uses MAGI income to determine eligibility for premium tax credits. So MAGI for Medicaid and MAGI for premium tax credit are similar. They're not identical, but they're close. So we are going to see changes in how Medicaid counts a household's income, and the ACA also eliminates most of the income disregards that are applied today in determining eligibility. And because of that, because of the loss of the income disregard, there will be a conversion of current income eligibility levels to new MAGI conversion levels. So in place of a number of income disregards, there's going to be a flat 5% disregard across the board. Now, one of the takeaways from today's session is that these changes do not apply at all to the aged, blind, and disabled. The rules that are in place today will remain the same for the ABD. So these changes are basically going to apply to kids, pregnant women, parents, the kids up to age 21, and to Plan First. But we'll talk about that in a minute. So after October 1, Virginia is getting permission from the federal government to apply these new income rules and the new MAGI rules to applications filed after October 1, instead of waiting until January to make these changes. So we'll start seeing some of these changes pretty soon. For children, and the category is now going to include the children under age 21 groups, those foster care kids and adoption assistance kids. Instead of the 133% of poverty, because there are no longer any disregards applied for like work expenses or child care expenses, there will be a new poverty line income level of 143% of the federal poverty line, and if someone is slightly above that level, they can have that standard 5% disregard to see if that will help them qualify for the same coverage. The idea being that when you eliminate the disregards, you don't want to suddenly disqualify a lot of people who have been enrolled in the program under the old system. So the higher poverty line level plus the 5% disregard is intended to keep eligibility basically the same. But obviously some people are going to benefit by this increase in the poverty line level because let's say someone didn't have any of the work-related expenses or child care deductions to use. Well, this is basically an increase in the poverty line level for kids. Famous, however, Famous for Children is going to stay at 200% of the poverty line because that has always been a gross income test, so it didn't require any kind of MAGI conversion because there weren't any disregards being applied in that program. So likewise, for pregnant women, the new poverty line level goes up to the 143% of poverty with the 5% disregard for people who don't meet the test. If they go slightly over, they can get a disregard. For famous moms, for pregnant women, which has been using income disregards up to 200% of poverty, the new MAGI conversion amount is 210% of the poverty line with a 5% disregard. But this program is ending after January 1 of 2014 at the direction of the governor and the General Assembly, the idea being that after January 1 of 2014, people who have income above 100% of poverty can get coverage through the new health insurance marketplace. But women who are pregnant and enrolled in Famous Moms by the end of December of 2013 can continue to receive their coverage through their entire pregnancy and 60 days postpartum. For parents, there will be new income levels, and because we have different amounts for different localities, the way DSS and DMAS are describing this is as a weighted increase for localities. So apparently some localities are going to be a little bit, there will still be variations in the eligibility levels for parents, and there will be weighted increases depending on how frequently those income disregards were used for parents right now. But we'll see a bump up, and I believe the plan after January is to consolidate the three groups of Virginia localities into one group of localities for parents, which would be a really good thing. For Plan First, which currently is at 200% of poverty, the income level is going up to 211% of poverty with the 5% disregard. But like Famous Moms, this program will change after January 1 because folks who have income above 100% of the poverty line can go to the health insurance marketplace. The breast and cervical cancer group stays the same. It's really not subject to MAGI at all, so it stays at 200% and still requires the CDC projects to approve eligibility for that program. And then the biggest change in the ACA is the new optional coverage for adults, which is another way to be talking about the Medicaid expansion, and that at this time is still pending in Virginia. But states that do adopt the Medicaid expansion will provide Medicaid coverage to all adults at 133% of poverty plus that 5% disregard. So you often see the new eligibility level under the Medicaid expansion as 138% of the poverty line. And like I said, this is still pending in Virginia. We're going to talk about the Medicaid expansion towards the end of this webinar. I also wanted to remind people that after January 1, there will be a brand new Medicaid category for former foster care youth up to age 26. Now, if you recall our first webinar, we talked about how the Affordable Care Act allows children up to age 26 to stay on their parents' private health insurance coverage. Well, this is the comparable program for children who are actually wards of the state. So former foster care youth can stay in Medicaid up to age 26, and there's no income test. So this is an important new change that will occur in Medicaid after January 1. And as I just said, I haven't seen the details about this yet, but I understand that parent eligibility, even without the expansion, our current eligibility with 3 groupings of localities will be simplified into a single income standard, which will certainly help some parents around the state. Now, I've just talked a lot about different income levels, but we also have to remember that the way you get to those income levels is to decide what the family unit looks like. So you have to figure out a Medicaid household unit to determine which federal poverty line amount applies and whose income you're going to count when you do establish your household. And this is where we get into some of the weeds. We start, in order to find out or figure out the Medicaid household size, we start with the tax filing unit. Just as we did in the last webinar when we were talking about premium tax credits, you start with your tax filing unit. And again, those are individuals for whom a taxpayer claims a deduction for a personal exemption. And this is exactly the same for premium tax credits. So this can include tax dependents who are not even living in the same home, tax dependents who aren't even related to the family. Those folks can be in the same tax filing unit for premium tax credit purposes, and they can be in the Medicaid household unit as well. And in addition, for Medicaid, and this is where premium tax credits and Medicaid sort of diverge, Medicaid will always include the following people who live together. Okay? Now, with tax dependent, as I just said, doesn't necessarily have to live with the family, but this next section only is about the folks who live together. So the parents are always going to be with the child. When you're determining the child's household, the parents are always going to be included, even if the child is claimed as a dependent by a non-custodial parent. So this is where you get into one of the intricacies and the differences between the Medicaid evaluation and the premium tax credit evaluation, and we'll look at an example in a little bit. Also, for Medicaid, you always put the married couples together if they're living together, even if they file separate tax returns. Now, that's not the case for those premium tax credits. For premium tax credits, as we discussed last time, they basically require the married couples to file joint applications for tax credit purposes. And then again, if they're living in the same household, you pull in the step-parents, stepchildren, and half-siblings. Step-parents is a new thing for Medicaid because the current Medicaid program does not count step-parent income at all. So this is a major change that's happening as a result of the Affordable Care Act. That will change some kids' eligibility when you start counting step-parent income. So watch out for that one. And then in addition, another difference between Medicaid households and premium tax credits households is when a pregnant woman is applying for coverage for herself, Medicaid will count the unborn for that income eligibility determination. So basically, a pregnant woman would always be counted as two people in a household, and if she can document that she's expecting a multiple birth, you could even get more than two people in her household for purposes of Medicaid eligibility. And this is a review of what we talked about last time, who can be a dependent. So taxpayers can claim personal exemptions for themselves and for their spouse and for dependents. And those dependents are kids and other relatives who meet certain requirements. And a person, it doesn't really even need to be a relative, as we'll see in a second. And a person can be a dependent even if he files a tax return, as long as he doesn't claim his own exemption. So this is all about tax filing units, and the point is that Medicaid will use a lot of the same rules that apply for consideration of premium tax credits. And these are slides, the next two slides we used last time to describe who qualifies as a dependent. And so for children, it can include all those children that is listed on the left. And if they're living with you for more than half of the year, if they're under 19 at the end of the year, or 24 if a full-time student, and if a child doesn't provide more than half of his own support. Those are the kinds of children that can be a dependent in your tax filing unit and therefore be considered as part of the premium tax credit household or the Medicaid household. And these other individuals, it could be a relative who you're providing more than half of their support. It could be a relative who's living in your home all year. It could be a non-relative for whom you're providing 50% of that person's support. And for those two different criteria, to be a dependent on your policy, they need to make less than $3,900 a year, not counting their Social Security. So what this does is really sets up a situation where there can be more people in your household for purposes of deciding what poverty line level to use. In Medicaid, you'll often run into situations where people are not filing taxes, so you won't have the advantage of looking at the tax filing uses for federal tax purposes. You won't see their tax filing units. So there are some somewhat different rules for families that are not filing taxes. And in those cases, you need to see who does live together. And for this purpose, you always include step-parents and parents children under age 19, and spouses. So if the family is not filing taxes, this is basically much like our current Medicaid rules, except for bringing in those step-parents. You won't bring in those dependents, those relative dependents, those non-relative dependents. So my reminder at the bottom of the page is that if the family does file taxes, you may actually have more people in the Medicaid household, like kids over age 19 who are still declared a dependent for tax purposes, end up also being part of the household for Medicaid purposes. Now turning to actual counting of income, what income counts, really there are very few differences between what income counts for Medicaid versus what income counts for premium tax credits. But we'll see in a minute that some of the changes really relate more to what will count as income in Medicaid after October 1st versus what counts for Medicaid purposes today. So now this slide is actually straight out of our webinar from the last webinar, and we learned about modified adjusted gross income as coming first off the adjusted gross income line of the tax return and adding in any foreign income and any tax-exempt interest, and also bringing in the Social Security benefits, starting with the non-taxable Social Security benefits. You add that back in because Congress realized that they couldn't follow the tax rules exactly, which allow a lot of Social Security benefits not to be counted for tax purposes, but they have to bring them back in for purposes of the ACA. And here's the list of the types of money that counts as gross income. And I put asterisks by the items that are fairly different from what we have today in Medicaid. So, for example, right now, when Medicaid looks at self-employment and tries to decide what the profit from self-employment is, they deduct expenses, but they don't deduct depreciation and capital losses, which are tax code deductions, which will now also apply when people are applying for Medicaid. So the result of this, I think, is going to be that self-employed folks are going to have a lot less countable income than they do today if Medicaid applications are filed. But on the other hand, since the tax code does count dividends and taxable interest, which basically don't come up very much in Medicaid right now, that money will count in the MAGI determination. So those are some of the main differences between Medicaid income counting today versus after October 1st with the MAGI calculation. And here are some of the exclusions from gross income. And again, I've marked the items that are quite different from what we have today. Workers' compensation won't count. Child support received will not count. And any families that are deferring some of their salaries into these cafeteria spending plans or 401k plans, remember, since we're running all this through the tax code, these are the kinds of things that don't count as gross income for tax purposes, so they no longer, it doesn't count for Medicaid purposes either. So this might mean that there are some middle income families, workers who do set aside $5,000, $10,000 of income for child care expenses or health expenses, and it will mean a reduction in their countable income for Medicaid purposes as well. Now, in preparing for this webinar, I looked at a lot of material, and I didn't reach a conclusion about gifts and inheritances. So I just put this on the list and said it's not clear because I'm not sure. Certain things don't count for tax purposes, but I read from several sources that gifts and inheritances would still count at least for 1 month in terms of the Medicaid determination. So we'll just have to get back to you on that question because I'm just not positive I know the answer today. Now, some of the subtractions from gross income, and over here we were talking about types of income that just don't count. But here are some subtractions from gross income. And again, you have contributions to a health savings account and things like moving expenses and student loan interest. These are things that the tax code allows for subtractions. And here you'll see alimony paid can be deducted from the person paying the alimony, but not child support paid. The child support paid doesn't count on, it's not deducted at one end and counted on the other. It just seems to be in limbo. And another thing to keep in mind for Medicaid, and this is sort of a twist on the rule, is that when you look at income of children and tax dependents, if their income is not high enough to require them to file a tax return, then that income is not counted at all in the Medicaid eligibility calculation. So if you've got students who are working part-time or kids who are working part-time and making $2,000 or $3,000 a year, it's just not going to count at all. I mean, Medicaid currently does have a rule that disregards most student income, so this is similar to it, but it's phrased in a different way. So unless those earnings go over this $5,950 per year, they're not going to be counted in the Medicaid gross income calculation. Now, for Medicaid purposes, what kind of verification and documentation is going to be required for applicants? So there's this new concept called reasonable compatibility, where the information provided by the applicant will be verified as much as possible through a federal hub, a federal data hub, and if the attestation of income is within 10% of what's found on the federal hub, no paper documents will be required. Now, we don't know yet how well this is going to work. We don't know yet how much information is going to be available through the federal hub. And since, people's lives change and their income from last year may not be the same as this year, it could still be that people are going to have to provide documentation of their income. But at least some folks who have fairly stable situations will be allowed to verify information through the federal hub and will not have to provide paper documentation. So this is something that we'll all have to just keep our eyes out for, see how it works. So again, and this is repeating some of the information I provided you earlier on to give you the new income limits for the various categories. And again, this is happening because they're eliminating the income disregards that have historically been applied in the Medicaid program. And so the state had to convert the old income limits to new MAGI income levels to basically take into account the average level of disregards that had been applied. So we've got children and pregnant women going up to the 143% of poverty, famous moms going up to 210, Plan First, the family planning services, going up to $211. And then here's the actual numbers. The 5% disregard. If the household's income exceeds those earlier levels, there is a disregard of 5% of the poverty line for different family sizes. So, I mean, mathematically, you could do it any way you want. You could take it away from the family's income, or you could add it to the poverty line level. But either way, this is what you add for a family of 1 through 4. And, of course, there are different numbers for larger families. And so this might let people squeak through. For example, a pregnant woman in a family of 2, you're going to add, if she's alone and she's pregnant, you call her a family of 2, so she'd get another $65 either deducted from her income or added to the poverty line level to determine her eligibility for Medicaid. So let's talk about a couple of examples, because I know this probably sounds fairly complicated, but I wanted to mostly point out where the Medicaid rules are different from the premium tax rules. So let's see if we can work through these examples. So you're not going to see differences in every situation, but you will see differences, for example, in this case where there's a child claimed by a non-custodial parent. So the mom, Lisa, lives with her son, and she's not married. The non-custodial dad claims the son on his taxes. So she's got $20,000 income. She also receives child support from the absent father, and the father has his own salary of $40,000. First of all, we now know that child support payments don't count, so you just disregard that whole $10,000 from Lisa's side of the ledger. It just doesn't count. So for Medicaid, she is, even though the son's living with her, you have to create your household person by person. And Lisa is a household of 1 with her $20,000 income. The son, however, because he lives with his mom, and for children, you always count the parents. Okay, that was one of the Medicaid rules. For children, you always count the parent that they're living with. So he becomes a family of 2. Now, Dad is also counted as a family of 2 because he is a tax filer, and he claims his son as a dependent. So that's how the Medicaid evaluation is going to be done. But when you look at the premium tax credit, the difference here is the son, while he's still a family of 2, he's a family of 2 with his father, because for premium tax credit, you stop at the tax filing unit, and because the dad claims the son as a dependent, the son is part of that household with his father. So the difference you see here is that for premium tax credit purposes, the son is a dependent of his tax filing father, and they are going to count together with a household income of $40,000. Okay, while in the Medicaid example, the son always goes with the parent he's living with, and she had the $20,000 income. So that's one situation where it is a disconnect between how the premium tax credits are going to be evaluated and how Medicaid is going to be evaluated. And I'm not smart enough to know if there are going to be people who fall through some kind of crack in the earth because of these 2 different ways of looking at family income. But you see that it does have ramifications because of the differences in the household rules. Now, another example where you may see differences between Medicaid and premium tax credits are when there are non-married parents. Okay, so here our example is that Dan and Jen are not married, but they live together. They're all together with their 2 children. Dan claims the children, and the mom files on her own. I mean, they can't file jointly because they're not married. Okay, and here's the 2 income levels for Dan and Jen. So for Medicaid, and you've got to look at each person separately to figure out what their household is. It's not as easy to just look at the whole family. So Dan is a household of 3 because he is a tax filer and claims his 2 children. So even for Medicaid, that's where you begin. And Jen, even though she is the mother of those children, she has to stay as a family of 1 with her own income. But then when you look at the children, they live with their parents, and they have to, the kids who live with their parents, bring the parents into their household unit. The kids both end up as family of 4 with countable income of the combined income of the parents. So you bring in both incomes when you look at the Medicaid eligibility for those children. Now for premium tax credits, the difference again comes when you look at the household for the kids. Here, because premium tax credits only look at tax filing units and that's it, the 2 children are only placed with dad. Okay, so the children, Drew and Mary, are households of 3 with the income level of just their dad. So here you see a pretty big difference in what kind of income is going to be counted for the children, but that's because for premium tax credit purposes, they are members of dad's tax filing unit, and that's where you stop. Okay, in Medicaid, the children are living with both parents, and you, for Medicaid purposes, you bring both parents into the children's household unit. So that's what I was going to say today about Medicaid income and Medicaid households. We'll take questions at the end of the webinar. So let's just keep moving on to our second topic for the day, which is the Medicaid expansion. And the big question is, will Virginia adopt the Medicaid expansion? As I mentioned earlier in the webinar, our current Medicaid coverage is really limited, very limited. We're ranked 48th nationally in per capita Medicaid spending. That eligibility for parents is really low. It's under $10,000 a year for a family of 4. And those childless adults who, they're not parents living with their kids, they're not pregnant, they're not elderly, disabled, or blind. There's no coverage at all for childless adults in Virginia. And that new optional coverage for adults, for people under age 65, could go as high as 138% of poverty, that 133% plus 5% disregard, which would be a significant, a huge increase in the income levels. For example, for a family of 4, right now the parents only get coverage if the family's income is under $10,000 a year, and it would jump up to almost $32,000 a year. So it's a significant, huge change in income eligibility through the Medicaid program, and all the estimates show that up to 400,000 low-income adults in Virginia could be covered if Virginia adopted the Medicaid expansion. Who are some of the people who could qualify for the expansion? Well, we know that there are about 22,000 individuals who get mental health services right now through community services boards, and those are services that are currently paid for with state and local dollars. Well, a lot of those folks are those childless adults with income under 138% of poverty who could get Medicaid. Older adults who don't yet qualify for Medicare because they're under age 65, there's over 60,000 uninsured adults who fall into that age range who are also lower income who could get Medicaid if we expanded coverage. The disabled folks, the individuals who are declared disabled by Social Security but are waiting for 24 months before they can receive their Medicare. They have lots of health care needs, but if they don't currently qualify for that 80% category or through the spend down program, they're basically left uninsured. Many of them could qualify for Medicaid if Virginia expanded coverage. Of course, the income level would jump for those low-income working parents who right now have to have income below 30% of poverty. They could qualify. And kids who age out of Medicaid at age 19, typically Medicaid just stops at age 19 unless they fall into, unless they're disabled or they fall into perhaps the foster care kids or adoption assistance kids. Most kids lose Medicaid at age 19, but they still have allergies or diabetes or other health problems, but they become uninsured right now, but they are the folks who could qualify for coverage if Virginia expanded its program. And the opportunity is such an important one, not just for the health care of all those folks I just described, but because the federal government would pay 100% of the cost of this expansion for the first 3 years. So under the Affordable Care Act, that 100% federal funding goes until the end of 2016, and then it gradually reduces to 90% federal funding by year 2020. And this is a lot more generous than our current federal match, which is 50%. So right now, Virginia pays half and the feds pay half, but under the ACA for this Medicaid expansion, the federal government would pay much, much more. And the estimates show how really lopsided the funding requirements are with the over a 10-year period. After all the number crunching's been done, it looks to us like Virginia over 10 years would pay $137 million towards the cost of the Medicaid expansion versus bringing in $20 billion of federal funding over a 10-year period. So it's really lopsided with the bulk of the cost coming from federal funding, which would be a real economic driver in Virginia. And it's estimated that that money coming into the state could support 30,000 new jobs, and those jobs create new revenue, generate new revenue for the state. And as I described above, there are lots of state programs, the mental health services, indigent care services, health services provided to prisoners, and other aspects of state-funded health programs that could be offset by the Medicaid expansion and the federal dollars that are available to the state to fund the expansion for that population of lower-income, uninsured people in our state. And if you've been following these 3 webinars, you can understand how important the Medicaid expansion is, because without it, we are left with a really terrible gap in coverage. You have the health insurance exchange, or the marketplace, available to serve people at 100% of the poverty line and higher, and people up to 400% of poverty get tax credits. Then you have our current Medicaid program, which for low-income parents is 30% of the poverty line, but really 0% of the poverty line is for so many of those childless adults. And in between is what's supposed to be filled by the Medicaid expansion. I mean, as originally designed, the ACA provided coverage to people all across the income ranges. but the Supreme Court made the Medicaid expansion optional, and without it, you are left with this giant hole in our healthcare system, which we call the Medicaid gap. So the 2013 General Assembly did consider the Medicaid expansion. The governor started the session saying he would not expand Medicaid without significant reforms to the Medicaid program. And while our campaign for Medicaid expansion was successful in many ways, and we did get a lot of bipartisan support from the General Assembly and from the Chamber of Commerce and other business leaders, ultimately the budget language that was adopted by the General Assembly did approve expansion, but only if many Medicaid reform conditions are met. And some of the kinds of reforms the legislature enumerated included a dual eligible project for individuals who receive both Medicaid and Medicare, requiring managed care to provide their services as a way to potentially save money to actually combine Medicaid money and Medicare money to serve that population. And this is a project that's being worked on right now by DMAS. The General Assembly also wanted more fraud prevention activities, wants services to look more like commercial insurance, and wanted to be stricter in terms of certain access to behavioral health and transportation, and generally to expand managed care to more populations, even though in Virginia we do have managed care for most of the Medicaid population right now. But there's a laundry list in the budget of about 12, 14 different specific Medicaid reforms, which, if implemented as required, could lead us to Medicaid expansion. And there is a legislative commission called the Medicaid Innovation and Reform Commission that has been put together to actually be the oversight commission looking at these Medicaid reforms. So there are 10 legislators who've met in June and August, and they're meeting again in a few weeks in October, looking at these Medicaid reforms and deciding whether or not enough has been done to justify the expansion. I give you the website here of the MERC and encourage you, if you'd like to submit public comments to the MERC. You can submit comments online at their website. And we also understand that sometime in October there may be a public hearing where the MERC will hear live from the public, so we'll let you know about that opportunity as well. So the way the budget language is written, the MERC has the authority to expand Medicaid if the reform conditions are met, but several legislators and the Attorney General have questioned whether or not the authority outlined in the budget is constitutional or not. And then, of course, there is the governor's election coming up in November, which is likely to have a big impact on the outcome. The new governor will have the opportunity to submit, well, Governor McDonnell will submit the budget, his last budget in December, but the new governor will be able to amend that budget as he wishes after inauguration. So those are other factors that will influence the outcome of all this. Here's the list of legislators who are on the Innovation and Reform Commission. On the House side, Beverly Sherwood was, she lost her primary to run again, and her position has not been replaced as far as we know. But there are 5 senators and 5 delegates, in addition to Secretary Hazel and the Secretary of Finance, Richard Brown. So these are the folks who are serving on the MERC right now, evaluating the Medicaid reforms and deciding whether or not to expand Medicaid. Generally, there seems to be than on the House side, so public comment is quite important, because this is a big issue for all legislators and candidates, and the media and the general public have gotten engaged in this issue. So I encourage folks who are interested in this to submit comments to the Reform Commission, to send letters into your local newspapers, and importantly, to share stories about the people who could gain coverage through the Medicaid expansion, and the problem with leaving that huge gap in our system, which would leave so many lower-income Virginians uninsured. So some of the messages that are useful to continue to share with others is the following ideas. To accept the federal funding, it's money that is available to cover more uninsured Virginians, and this is a way to use the federal tax dollars that we pay to use those tax payments in our state, and instead of supporting expansions in other states. We know that having health insurance contributes greatly to financial security and emotional security for people who are working really hard, and without health insurance, there's so much worry about paying for medical bills, the risks of bankruptcy when people get sick. And this coverage gap, I just think, is really compelling. To me, it leaves hundreds of thousands of Virginia's poorest residents without any health care option. And the money available from the federal government is quite significant in terms of generating economic activity and creating jobs, all which would help Virginia's overall economy. That brings us to the end of this webinar. We'll take your questions in a minute, but let me remind you that you can find these 3 webinars. It'll take a few days to get this last one up. You can find it on our website under the health law section, and that'll give you a link to YouTube where you can listen to the whole webinar again. And the Center on Budget and Policy Priorities has been a great resource. They have a whole series about health reform beyond the basics. Several of the slides and many of the examples I've used over the past couple of programs have come from the Center on Budget, and you could see their whole series. And then another reminder that for a lot of information about the Affordable Care Act, please go to the federal website, healthcare.gov. That is where people can learn about the Affordable Care Act and actually set up an account and file applications for premium tax credits, and also your applications will be screened for potential Medicaid eligibility. And the National Call Center is operational today 24/7 with lots of language access for folks who have questions about the ACA. So I'm going to wait a minute or so to look at your questions. We do have a couple of them here. Okay, let's just start with the questions that have come in. The first question, will the foster care rule apply to kids who were adopted with special needs adoption subsidy? And I assume you're talking about the foster care rule that allows former foster care kids up to age 26 to stay on Medicaid. The answer is no. It's for foster care children, not special needs adoption children. It's just for foster care children. Next question. So as of January 1, 2014, parents with children under age 26 will have coverage. Did I hear that right? Well, right now, under the Affordable Care Act, children under age 26 have to be allowed to stay on their parents' private health insurance. That's what I was referring to when I was trying to explain that the foster care children will have a similar kind of benefit by being able to stay on the Medicaid program until age 26. But today, and my own children are good examples of this, my children who are in college are still on my health insurance plan because they're under age 26. So that's one of the current benefits of the Affordable Care Act. Next question, can you claim someone as a dependent if the someone has a TIN number? Would they qualify for the tax credit? The TIN number, I believe, is for legal immigrants who have the ability to work in the United States. And my understanding is, yes, that people who are legally in the United States with status can participate in the new marketplace and get tax credits for their coverage. Next question. What if a 20-year-old full-time student lives 10 months out of the year at college and he's living off student loans while he's at college, and the other 2 months he works and makes less than $5,000 a year? Does the student qualify for Medicaid as a household of one? Well, I guess I have some other questions. Will that 20-year-old student be declared or claimed as a dependent of his parents in the parents' tax return? If so, he would not be a household of one. But if between the loans and if he really is independent, living off of loans and making less than $5,000 a year and is totally independent from his parents, then he could apply for Medicaid. But I'm afraid that without a Medicaid expansion, he won't fall into any of the current categories, so he probably would not qualify for Medicaid, and $5,000 a year is not 100% of the poverty line, so he wouldn't qualify for premium tax credits either. So if he's independent, he's going to fall, with these facts, if he's independent from his parents, he probably falls into the Medicaid gap, yes, as a household of one. If he is still a dependent of his parents, he could have the chance, looking at their income as well, he could have the opportunity to get premium tax credits for private health insurance. And if the parents also are low income, and they all together also have under 100% of the poverty line, then all of them will fall into the Medicaid gap, assuming that the parents are not elderly, blind, or disabled. Next question. What if a male U.S. citizen and disabled veteran has low income and no resources and has 3 infants? Whoa, this is a complex question. Okay, starting over. What if a male U.S. citizen, disabled veteran, has low income, no resources, 3 infants, and they are receiving Medicaid and SNAP, but his wife is not a citizen, but she's had a green card for 5+ years. Is she eligible for Medicaid benefits based on being the spouse of a veteran? Okay, this is getting into the whole arena of which legal immigrants can qualify for Medicaid. And there are rules that say green card holders who do have a connection to the military, which she does as a spouse of a veteran, can get Medicaid if they otherwise qualify for Medicaid. Well, so that's the answer to this is yes, she could qualify for Medicaid, or I should say she wouldn't be disqualified from Medicaid because of her immigration status. But again, the problem here is that the category she falls into is as a low-income parent. And right now, the income level for low-income parents is under 30% of the poverty line, which is really, really low. I can't quite tell if you were suggesting the veteran father is on Medicaid. If the veteran father is on Medicaid, it could be because of his disability. The mother, who's in the category of low-income parent, has a much lower income test unless Virginia adopts the Medicaid expansion. If Virginia adopted the Medicaid expansion and the whole family was under 100% of the poverty line, they'll can fall into that Medicaid gap. Next question, why the age for students is 24 and below and not 26? I don't know the answer to that. I mean, the 26 relates exclusively to the Affordable Care Act. I don't know why in the Affordable Care Act they chose age 26 for the age that children can stay on their parents' private health insurance coverage. The age 24 for dependents is an IRS rule. So I guess the only explanation, it just comes out of two different laws. I don't know why. Next question, will any of the non-financial requirements for Medicaid stay the same, such as the 5-year waiting period for lawfully admitted alien residents? Yes, the immigration rules all stay the same. And in Virginia, we actually not only have a 5-year waiting period for lawfully admitted aliens, but we also have a prohibition after the 5 years unless the person can show adequate work experience or a connection to the military. So I'm afraid that the provisions for Medicaid for legal immigrants has not changed because of the Affordable Care Act. Now, some legal immigrants can go to the marketplace and purchase private health insurance and could get premium tax credits, or they could be better off, even if they can't get premium tax credits, they might be able to buy a policy through the exchange that could suit their needs. But the Medicaid rules for immigrants have not changed. Next question, how will this affect the grandparents who has custody of the grandchildren? Is their income factored in? Well, if the grandparents are declaring, if they have custody of these grandchildren and they are declaring them as dependents on their tax returns, then there will be a connection to the grandparents' income. If the grandparents do not declare the grandchildren as dependents, while the Medicaid rule about step-parents has changed, and step-parent income will now count after October 1st, there is no change in the current rule that says you don't count grandparent income. So it will all depend on whether or not the grandparents declare these grandchildren as a dependent on their taxes. And if they don't file taxes for some reason, I would say know, the grandchildren, you don't count grandparent income for Medicaid purposes, so you would only look at the income of those grandchildren themselves. Next question, I have a 22-year-old that files separately. He works part-time. Can he apply for the Medicaid expansion program? He has no health care coverage. Well, please remember, in Virginia, we don't have a Medicaid expansion. The General Assembly is still considering Medicaid reforms and has not adopted expansion. So a single 22-year-old, unless that person is disabled or pregnant, there's no category for that person to get Medicaid. If we had an expansion, that would be a good example of someone who could benefit from the Medicaid expansion. But with the gap we have right now in Virginia, I would look more to the question of whether or not that 22-year-old has enough income that he has more than 100% of the poverty line, which would allow him to go to the health insurance marketplace to get private health insurance with premium tax credits. Okay, and I have a clarification of an earlier question. He's receiving, this was the person that we were talking about before, the veteran. It sounds like the veteran father is getting Medicaid based solely on his low income and no resources. Well, then his wife, the green card holder for more than 5 years, who has the military connection because she's married to a spouse, she should also be part of that Medicaid household. So that looks like something that that family should follow up with. I don't know any reason why she would not be a part of the Medicaid family, since she has the green card and the 5 years in the U.S. and a connection to the military. The final question is encouraging me to be even more encouraging about the Medicaid expansion. Well, I told you a lot of things about what I hope all of you will do in terms of talking to your to members of the MERC, talking to other legislators, talking to your friends and neighbors. I think when people understand that without a Medicaid expansion, we have this gigantic hole in our healthcare system which hurts lower income people, people might realize it's a mistake to not take advantage of the opportunity to expand the Medicaid program in Virginia. So I'm just going to bounce it back to you guys and say, you know, do what you can to explain this to people. And I think after October 1, when we have open enrollment starting for the health insurance marketplace, that a lot of people are going to come forward who will end up falling into the Medicaid gap. And when that starts to happen and the reality starts to sink in, I think there will be even more compelling examples of why the Medicaid expansion is so important. Okay, another question just came in. What about a single mother who's retired and collecting Social Security? She has dependents over the age of 19 but under 26. Can the children apply for anything? Well, I guess the question is if those 19, if the kids between 19 and 26 are uninsured, if she declares them as dependents, then yes, they'll be in a household with her for both premium tax credits, and if they're living with her, then they would be part of the same household for Medicaid purposes. But without the Medicaid expansion, that age group falls into the Medicaid gap unless the kids are disabled or pregnant. But there could be a possibility of private insurance and premium tax credits if this group of people have income above 100% of the poverty line. Another question, for parents' eligibility for Medicaid under MAGI, do you have a ballpark understanding of the percentage increase from 30% to the higher FPL level with the 5% disregard? My ballpark understanding of this is that because the current eligibility levels for parents depends on where you live in Virginia. There are 3 different groupings of localities, so there are separate figures depending upon where you live in Virginia. Each of those numbers, I mean, if it's, let's say in Southwest Virginia, it's about 22% of the poverty line. In Richmond, it's about 25% of the poverty line. In Northern Virginia, it's about 30% of the poverty line. I expect because of the MAGI conversion, all of those numbers have jumped up a bit. So instead of 22%, it's probably closer to 27%. And then you get a 5% disregard on top of that. But we're waiting for specific information from the from DMAS and DSS. They've done some of their new income charts, and we'll be publishing those numbers as soon as we can. Another question, Plan First recipients, will they have to apply to the marketplace since the insurance is only family planning and no comprehensive health included? No, I mean actually Plan First is a family planning program that's run through Virginia's Medicaid program. And people can apply either starting at the federal marketplace or through state, local departments of social services. People can apply online, people can apply by paper, so it doesn't really matter where you start the application. If the only thing someone qualifies for is Plan First, then their application is going to end up back at the local Department of Social Services for enrollment in that program. So they can start at the federal marketplace. They'll be told they're not eligible for premium tax credits because their income is under 100% of the poverty line, and then that application will be transferred to local departments of social services. Next question. To what extent was the fact that dependent care paid for by parents is not excluded from MAGI as it was under previous Medicaid eligible in the new threshold? That is how the MAGI conversions were calculated. They actually had to analyze their cases to determine, you know, on average, how many children were given a disregard for child care costs in order to be found eligible for Medicaid at the 133% of poverty. So they analyzed their current caseload to see how frequently that dependent care deduction was used, to see how frequently the student income exception was used, and how frequently the job-related expenses deduction was used. So I'm not familiar with how all the specific calculations were made, but it was all mixed together, and it resulted in the conversion for kids from 133% of the poverty line to 143% of the poverty line. Any other questions? Well, if not, I will say thank you so much for participating in the webinar. And again, we will have this webinar, the recording of this webinar, posted as soon as possible on the VPLC website. And I hope that these 3 webinars in combination have been useful to you. And my contact information is on the front page, so feel free to contact me as questions come up. And I'm sure that after October 1, when a lot of this gets into full gear, we'll have lots of questions to figure out. And I look forward to working with you on that. So thanks very much, everybody.